Welcome to a new version of explaining the fractal trading system, the trend following approach that you can see on my YouTube channel pretty much every week in the weekly recaps. Let's take a look at the basics of the system so that you understand what I am talking about. First of all, it's a trend following trading approach that I pretty much use simply to catch major market movements. I'm not interested in small stuff. I'm not interested in picking highs or bottoms. I want to catch major market movements by trading the right breakout signals. This fractal trading system is designed to trade in both directions, long and short. It incorporates market volatility. It's not using an ATR, but by using one of the indicators that I explained down here, we are easily able to take into account market volatility, and we can manage our risk well using the indicators. We want to stay in trends for months until they bend. We do not want to trade for 2 or 3 days. Ideally, we stay in a trend between 6 to 12 months because that's how long the big moves take in today's markets. We therefore trade medium and long term, and we can use this trading system on all markets. It doesn't matter if you trade commodities, if you trade stocks, if you trade forex, you can use this on any asset class. Three indicators are used for the fractal trading system, and first of all, these are the fractals themselves. They are used to determine market structure and support and resistance zones. Then there is an indicator called alligator, and that is what I refer to as the balance zone. That's where the price would be in a correction, or that's where the price trades to in a correction. After you had a big move, the market is going to consolidate, and this consolidation will head into what I refer to as the balance zone. That's where the market trades when it wants to breathe. When it has had enough of up or downwards movement, when it wants to breathe, it goes right there. And then we have the AO, which is short for awesome oscillator, to determine the momentum. Now, please don't pay too much attention to these stupid indicator names. They are created by Bill Williams back in the early 1990s, and they gave this stuff, I guess, for marketing purposes, some names that do not seem too trustworthy here nowadays, but in my opinion, they really fulfill their function, and they really do what they are supposed to, as we will see when we go ahead and analyze a trend using those indicators. Before we do that, we need to mention that this trading system follows basic market structure to determine corrections that will likely be followed by a big market move. So don't make the mistake of thinking that when the market has gone up, maybe like this, that you are entering here and the market is just going to continue up in a straight line. That's not how the market works. The market will always move in different phases. The Elliott wave guys will call these things waves, and maybe they are waves, but in my opinion, if you count waves, then you are simply kind of putting a theoretical concept on the dynamic market movements that are always subject to traders feeling and thinking completely different things every day. Sometimes they are not there, sometimes they are there in an emotional state where they take on too much of a position, or they take out their positions, and we have globalization going on now where the access to worldwide markets for everybody changes market structure a little bit, in that you will see a lot of divergences, double, triple divergences. You also see a lot of extensions and rapid moves, V-shaped corrections. And it's very tough to put in exact wave counts on different time frames to get to that one correct wave count. That's not what we want to do in the trend following approach. We want to follow the market after it broke out. And we do not count these waves here, but there definitely is a relationship between these moves. And we want to always catch the market, the market meat, the middle part of a big trend. So we want to take a breakout there, we want to take a breakout here, we want to be exiting in this correction, and we want to be exiting here before we take the market short as it heads down after making these five kind of waves up. But please remember, this is not Elliott wave. We are only looking at market structure, and we are using the awesome oscillator to determine the momentum in a way that we can see these kind of waves going on even though we do not count them. Once we are in after the breakout, we let the market run. We don't know how far it will run, and we will have rules that stop us out in these areas, but we will not go in and say that this is a wave 3 and this is 4 and this is 5, and after this the market has to come down for an ABC correction or something, because we never know if we see something like this continuing, and there's no way to determine how much, how far, how long the market really wants to head in the same direction. So we have rules that will trail the stop behind the market, and as the market goes below that, uh, we are simply stopping out, for example, in a scenario like this. So we are looking at this market structure, and this is the basis of the indicators that have been explained right up here. Let's now take a look into one of the trends that had occurred in the past, and let's analyze this market so we can understand this theory a little bit better. Now, we can only analyze this in the past as it is the only thing that makes sense as I'm explaining this trading system to you, and it's your task to go into your charts and to take a look at medium and longer term trends and see if this is something that you like, if this is something that you could follow and implement these rules. Now, let's take a look at this market that I have prepared here. What we see is the indicators I have been mentioning. I will say something more about them in a second. Very important when it comes to catching a fresh market move is market structure, and it's also very important that you start at the higher time frame. In our example here, I am just assuming that we are trading weekly bars, so the higher time frame we go to is the monthly. If you were trading daily bars, your higher time frame is the weekly. If you're trading 4 hours charts, your higher time frame is the daily chart. And what we want to see on this higher time frame is, where are we in market structure? Now, when we take a look at this Nikkei market here, we really do have nice charts in TradingView, even in the free version. Absolutely recommend this trading platform. When you take a look, we have the Nikkei here from 1971 all the way out to 2011 here right now. You see a massive uptrend, and just like market structure is telling us, we can actually see that in here we do have something like, and now we are not counting waves, I'm just saying that this is the first wave or the first move which is corrected, followed by another move which is then corrected, and we can assume that something else to the upside will follow. Now, regarding this as the basis, when we are here in this area, we have made this move, we have corrected, and now we've come up. When we see the market turning up here, taking us out of our long positions, we can see the market heading into a correction. We are again assuming that at some point when this correction is over, we are heading out, simply because of basic market structure. We don't know how long this correction phase will be. We don't know how deep it will go or how choppy it is. Sometimes you see stuff that goes down and moves out right away. Sometimes you see stuff that moves like this. Therefore, we always have to know what kind of basic setup we want to see to enter into a fresh trend. After the trend is finished up here, the market is moving down. It is establishing a little bit of a downtrend even. Now remember, this is the monthly chart, so you will get tradable moves here in these kind of market phases where we're actually in a correction overall. But if you trade 4 hours or dailies, you will get nice moves in here that you can trade. But after they are over, because of market structure, we are looking for the market to continue up. So we try to determine on this higher time frame times where the market is likely to reverse, and it will always do that in these marked rectangle areas here. There are even more when we take a look a little bit more to the right side here. There is another one here. As soon as the market comes on top of the moving averages and creates these up arrows, which are the fractals, we are trying to buy. We are trying to get on board of the old trend direction, which is upwards. Only when this doesn't work here after the first rectangle, we are looking for this to short. We are looking for an entry in the correction in case the market is going to go down quite a lot after failing to act upon this very first scenario where it could have gone up. This will be a little bit clearer in just a moment. But this is what we're looking for, these rectangle areas. Where is the market coming up again, giving us a breakout and then possibly continuing higher? That's where we want to hop on the train. In all of these rectangle areas, this is the case. In all of these levels here, or at these levels where you see the black lines, you have opportunity to go short in case we are totally wrong regarding basic market structure. In case the market is not coming up and is not following what we just said, you want to follow the trend, as we are talking about a trend following system. We want to follow this second option, that the market could also come down after it didn't go up. And this is what happened in the first, the second, the third, and also the fourth scenario here. It hasn't been until the fifth scenario that the market is picking up its previous uptrend. Now, when you take a look at the time dimensions on this, we are talking, or we're looking at the monthly chart. This is 1971. The market topped out at early 1990, late 1989. Now you have a correction going on all the way out to 2011 here, before this market is coming up again, as we will see in a moment. So that's 25 to 30 years where this thing was correcting. Now this is exactly what we want to look for when we are trading a trend following approach. I'm not saying you have to look for corrections that are 30 years long, but you want to look at corrections maybe that take a couple of months, maybe 6, 7, 8 months, maybe a year, where a market that has clearly shown you a previous trend direction, like here, an uptrend, then headed into a correction for many months. This is very, very likely then to present to you a very successful breakout with a huge move to the upside. And this is where you want to be in. This is where you want to catch the breakout that you will find in this area. And this is where then the great move continues. Of course, there are no guarantees in trading. We don't know if this is what happens. That's why we want to apply appropriate risk management rules in case we are wrong. Now, this is not the topic of today. We only want to take a look at the market and how we trade it. Now, we will zoom in a little bit more and take a look here at this level. We have the market trading in a range, not coming lower, and this also for many, many months. So we get again this area where the market is on top of the moving averages and now possibly breaking out. Let's take a look on our trading time frame now on the weekly chart, what this looks like and how we can get into this to follow the market to the upside. Now, the rectangle that we just saw on the monthly chart, we are now looking at here on the weekly. We get, let me remove this for clarity now, we get a side move with numerous fractal areas. Let me first explain what I mean by fractal. We have two different types of fractals. There are up fractals and there are down fractals or cell fractals. The up fractal will mark resistance, and when the market goes beyond the fractal, meaning it exceeds the fractal, we are going to buy. We have fractals down here. We also have a fractal here. All of them worked as the market showed us a nice trend after they had been hit right here where the black line marks the breach of the resistance zone. The same is true for cell fractals. We have fractal areas down here. If the market goes below them, we sell. Stop is always on the other side of the fractal. So if you buy here, your stop is down here. If you sell here, your stop is up here. Now, which fractal you are going to take will take a little bit of work using this system. Usually you will take the furthest fractal out in a fractal area. So either this fractal here in the middle because it's the highest, this fractal here because it's the lowest, or even this fractal here if you want to buy as the highest fractal in all of this side move that we marked with the rectangle on the monthly. Okay? So, trend unfolds as we have been successfully entering after a longer term correction after we saw that breakout to the upside. Now the market is moving and we don't do anything now. All we have done so far is we have watched the Nikkei for 30 years. Now that's of course an extreme example, but we have been watching a market for 5, 6, 7, 8 months before we can get in and the market is actually showing us some potential to go somewhere. In this case it was 30 years, so that's not the best example, but it's the clearest from an explanation kind of standpoint. Finally, the market breaks out to the upside, and now we again do nothing else but wait. Patience will be a very, very important um, discipline in your trading arsenal as you try to apply this trend following approach, because in all of this time here it may look easy now, but you sit there for months, even up to a year, until this can unfold. Now, as the market is finishing its trend, you have numerous ways in this fractal trading system to get out of the trend. You can do it really easily and securely simply by exiting as the market approaches the balance zone. Now, the balance zone again is these three moving averages here that have been scientifically researched by Bill Williams of Profit Unity, and this is pretty much the place where the price always comes back in a correction. When you take a look here at all of those phases where the market was weak, it always came back into the balance zone. That's the place where the market wants to be as it goes into a correction. So as the market approaches this balance zone, that's where you have or where you could have your stop. The market comes down at the end of the week or at the end of the day or at the end of your 4-hour candle. That's where you place your stop. If the market goes below it, you are out, you have taken profit. You can also use a fractal inside the balance zone, wait for it to be created, and then place your stop there, let the market run. There are numerous other ways to get out of a trend. You can use different moving averages and the ATR stop. You can do a lot of things. You just have to find out what you like best. For me, it will be the fractal stop right there, even though you have to make sure that basic market structure on your higher time frame is actually working and you know where you are and you're pretty sure, I'm saying this in quotes, you're pretty sure that you are correct in your market structure analysis, because only then will you get continuous trends, will you get 5 waves, again saying this in quotes, 5 waves to the upside that will take the trend further and further and further, and just at some point you're stopped out with your fractal. That's about it. There is only one more thing that's very important when it comes to this trend trading approach. If you take a look at a trend, and that's why we were previously saying that these 1, 2, 3, 4, 5, now you get A, B, maybe C, and then it goes again, 1, 2, 3, 4, and 5. In these kind of areas here, very often you get extensions, because as the monthly chart is in a trend, it will take a long time for all the time frames to have come up with the very, very top of the trend. You will always get a lot of momentum in this kind of scenario, in this kind of move, as there are, or as this is a very fresh kind of uptrend or a fresh trend, and a lot of people are jumping on it. First, you get a lot of stops taken out, then you got a lot of people turning bullish, and this just takes the market up and up and up. Now, as this is over and you get your first correction, you have the dip buyers coming in. So the trend again continues, and nobody knows how long it's going to go on. In this case, the trend went up for 2 years, simply because it takes that long for the market to come from one level to the next level because of some fundamental change in the market's structure, in its economy, basically in its fundamentals. It will depend on if you trade a currency or gold or a stock, what the reason is. And we absolutely do not care about the reason. We just assume right from the start that we don't know where the market is going to go, and therefore we are letting it run. Everything that works, we simply let run. We will be taken out by the fractals, and we will not put a price target for our positions in this market. Okay, that's very, very important in a trend following approach. No price targets. We calculate a risk as we enter the position. We put in the entry order, we put in a stop, and then we just let it go. If it works, we'll have an open target. If the trend runs for 6 months, all right. If it runs for 2 years, all right. If it stops us out after 3 weeks, also all right. The basic idea behind all of this is that you get risk-reward ratios from like 5, 6, 7 to 1, even more than that if you have crazy moves. And that's really about it. If the market does have these outlier events next to these usual trends occurring, and we want to participate when the market goes 50 or 100% or even more in stocks. So what you do get is a a fresh trend after it broke out from this side move, and you get momentum really, really coming up. As you can see, it gives you a peak in the momentum oscillator down here. As the market is starting to correct, you do have two different types of corrections that will again tell you about market structure. Correction number one, we can see here, it's marked by number one. And again, you find number one down here. What this is a combination of major and minor corrections. If you see after an uptrend that the market is not going in the oscillator down here below the zero line, but it stays above it, like in this case, you have your correction at number one, and down here at number one, we have the oscillator retracing from the high, but it's not going below the zero line. That is a minor correction. A minor correction means that on the lower time frame, the market is actually below the balance zone, and the oscillator is also below the zero line, and you have a major correction on the smaller time frame. But as you can see, the balance zone is acting very well as a support here at those places, and the market always turns up again. So this tells you, this minor correction, the trend is not over. If basic market structure is on your side, then you are somewhere in here, and the market is going to continue up. It's not going to be a long short kind of a game that we play. We want to give the market the room to breathe in such a case, and then take it up, stay in the market, and only when the market comes and does what we can see at number two, going below the zero line in the oscillator, we have our stops in place below the fractal, and we get out of the market. Because this is the major correction. This is where the market possibly heads to the old lows or even lower from the minor correction. Usually these are the relations that you will see between these moves in basic market structure. Now, in this case, it wasn't true because there was so much upside momentum. The market immediately turned to the upside again. It gives you all of these fractals, and it continues even higher than that. This tells us where we are in market structure and what we can expect. Usually, this is a first move down here. This is the second one. The peak of your momentum oscillator is the third move. Then you get an internal fourth move and 5. And that will be your first divergence marked by that blue line here and the blue line there. That is your first divergence in your minor correction. You get the minor correction and that will give you this first divergence without the momentum oscillator having gone below the 0 line. As the market continues and giving you that high here, it will head into a major correction, which we find here at number 2, and this is the other blue line of divergence that we get. And this is, again, 1 and 2 and 3, internal 4. Here this correction is internal 4, this is 5. Now we actually get real 4 and then a fifth move to the upside before we will be going into A, B, C. Again, we don't count this, but this is basic market structure that you find, including all of these extensions and drastic moves that can come much, much lower, and they can even prove you wrong as they are going lower. Following this, we always see the same thing in our momentum oscillator, and this determines for us where we are in basic market structure. As soon as you have a divergence that includes a major and a minor correction, you know that this market move is coming to an end. It's not going to be a fresh breakout anytime soon before this market hasn't gone into this ABC kind of mode. It's very important to understand you can always see market structure in the indicator down here. Now again, we don't know how many divergences there will be, and here again we don't know how many divergences there will be, but it doesn't matter to us since we are not taking profit simply because we see that divergence. What we are actually doing is we are letting the market run until it stops us out. And after we're stopped out, we go into the momentum oscillator, and this oscillator tells us very well where we are in market structure and in which direction our next position should be going. And that's pretty much all there is to this fractal trading system, even though the video has gotten pretty long. In my opinion, if you just look at enough charts with these indicators and that explanation just given to you, it will be very easy to see this on every time frame again and again. Very soon you will notice that trading is not about knowing the system that is the holy grail to profits. Trading is about managing your risk and knowing what you're doing, managing your risk and your own discipline, your own patience to actually execute what you theoretically already understand. That is probably for very motivated people in the business the most or the biggest problem. They know everything, and this is just a very simple trend following approach here. They know everything. It's absolutely understandable for everybody who puts in the work, but can you actually execute? That is the big question, because this is a psychological and a risk management question and not a question of your methodology. You do have to have a back-tested approach that's clear, but it's really a question of how you apply it and not about finding the magic indicators that will make you rich overnight. Thanks for watching this. You can come back to Fractal Trading on YouTube every week for a weekly recap on major markets. We're covering DAX, Nikkei, S&P, we're covering gold, silver, we're covering the bonds, we're covering every major market pretty much to see where we can make the biggest profits. Thanks for watching. Like the video if you like it, and hopefully see you soon.